Hello, and welcome to an introduction to the Small Exchange. I'm Frank Caberna, and today I'll be talking to you about new products that are coming your way. We're very excited to team up with Cannon Trading to give their customers access to futures that are small, standard, and simple. You can get more information at cannontrading.com/community/small exchange. We hope you enjoy our tour of the Small Exchange. The Small Exchange is making futures markets more accessible to more people. Now, why would we tackle futures? They have such great advantages that are exclusive to them, but it's also as if every advantage comes with a drawback to the retail trader. It's currently a world of this or that, give or take, and this is because traditional futures were not constructed with that retail trader in mind. Now, before diving into how the Small Exchange is fixing that problem, let's take a deeper look at the pros and cons of the futures of old. Compared to stocks and ETFs, futures are much more economical, but they're also more unwieldy. What does this mean exactly? Well, every product that you're able to trade comes with a capital requirement and a size. If you've lived primarily in the world of stocks and ETFs, then you have to pay either half or all of the product's size and capital requirements. The efficiency that's so often talked about in futures comes from its much smaller capital requirements, which means you have to put up just a fraction of the product size to trade it. But what about that product size? Well, traditional futures were made for large institutions, which means you're stuck trading huge products. The products can be so big that many traders can't adopt them even at lower capital requirements. Smaller percentages don't necessarily translate to easier access. Another trade-off between futures and stocks comes in the way of futures' greater accuracy in tracking an asset, which has long come at the expense of consistent construction. How can something be accurate and inconsistent? Let's check it out. The term pure exposure is often referred to when speaking on futures. All that means is that a futures product tends to be better at tracking a commodity like gold than a bunch of stocks that deal in the mining industry. This is because futures are directly tied to the index itself, whereas stocks merely relate to it imperfectly. Stocks tangentially get close to the benchmark, but don't fully capture what the index is valuing. Futures, on the other hand, are a little less attractive to traders when you find out that their characteristics vary from contract to contract. While stocks lose in the pure exposure department, they more than make up for it in their consistent construction. Many traders are willing to give a little in correlation or pure exposure to trade ETF shares that they're comfortable with. And finally, futures are more dynamic than stocks and exchange-traded products, but they're also a lot more confusing. This has long been a battle between not enough and too much in the way of distinct markets that could show potential opportunity. Here are the broad strokes on this pro and con. The exposure advantage in futures lends to a great deal more variety than can be seen in stocks. While ETFs attempt to emulate the indices that futures directly track, they still tend to act like stocks. And so, opportunities for traders living only in the stock and ETF world is exclusively tied to opportunity in equities, whereas futures that span asset classes like metals and foreign exchange let you jump from market to market as movement cycles in and out. But traditional futures can take this idea a little too far. Since these products were primarily made for large institutions with very specific needs, the products lack a broad simplicity. For example, if you came to your platform with a trade idea for the US dollar, but were prompted with several choices in trading its exchange rate, then you'd be looking at even more research before you could finally execute on that idea. At least stocks' lack of dynamic nature lends to a simpler approach. And this is where the Small Exchange comes in. The goal here with the Smalls is to take all of those advantages of futures that make them more efficient products, pare back their large size and complexity, and add that ease of use that is currently only seen in stock products. No more this or that. The Smalls are built as a new kind of product that are futures but don't necessarily look or feel like it. The days of pros versus cons are behind you. Time for small, standard, and simple. These are the three pillars that we are counting on to execute our mission of bringing greater accessibility and thus more people to the market. We have created products that fit almost any trader's portfolio, require little to no contract specification studying to jump on board, and get you trading across several asset classes as quickly as possible. So how does small fix both the high capital requirement problem of stocks and the huge size problem of traditional futures? By keeping the size small enough for anyone to adopt and the requirements at a small percentage that maintains an efficient use of capital. Regardless of whether the market is priced at $1 or 10,000, you will only need to put up a fraction of that amount to trade, usually between 1 and 25% depending on the market. This comes at a great discount to the stock or ETF version of this same market, which either demands you pay for half or all of the product to trade it. But here's the catch with traditional futures. They aren't the same size as a few shares of Apple or your favorite ETF. They're usually hundreds of thousands of dollars. And after some number crunching, you see that these products cost thousands of dollars to trade, and they exhibit thousands of dollars of risk in just a few hours' time. The smalls keep that low requirement on your capital, and they add the flexible size not currently available in traditional futures. This makes for a manageable margin value, only demanding a couple hundred of dollars to trade. You still get the efficient potential for larger returns that are exclusive to futures, but at a size that gives more people access and allows for larger traders to scale up and down easily. Let's take a look at an example of a stock market that trades with the size of a traditional future, in black, and compare it to the smalls equivalent, in red. The first thing you notice when keeping the vertical axis in mind is daily swings of thousands of dollars and longer-term changes of tens of thousands in traditional futures. And then when you look at the stock market at smalls, you see essentially a flat line by comparison. But what's really going on here with the small stock 75 is simply a smaller version of the same opportunity. It's a stock product that sees the same movement as the traditional benchmarks, but at a smaller fluctuation in terms of relative dollars. Instead of moving thousands of dollars per day, we are moving at a pace that is more adoptable for everyday traders. Our stock product is currently moving just over $100 per day, relative to a few $1,000s in the traditional futures equivalent. The same goes for our metals product that is now at just under $100 per day, compared to daily ranges in gold and silver futures averaging in the thousands. This idea also lends to foreign exchange products at the small exchange, where our dollar product is almost a tenth the size of the old FX futures. And our crude oil is going to be small as well. No more $1, $2, or $3,000 crude days. You can trade oil at a fraction of those notional swings. And finally, our sleek 10-year yield product is going to tick in yield, which is both simpler and smaller than big clunky treasury futures of old. No more sacrificing higher potential returns for a more flexible product. Get the best of both stocks and futures, with small sizes and requirements. Reduce size, not opportunity. You've always had to choose between accuracy and consistency when looking to implement your ideas. Why do markets like metals require a choice between something that tracks directly and something that looks like other pieces in your portfolio? Until now, you've had to trade either gold stocks or gold futures. The gold futures get you directly to the world of metals, whereas gold stocks get you one step further by dealing with companies in the gold business. If you're looking for bars of gold, silver, or platinum, then you probably shouldn't be trading an ETF that holds companies with CEOs and departments that rarely come into contact with the hard commodity. When looking at adding precious metals to your tool bag, you want to gain exposure in precious metals. The last thing you want is to think you are getting exposure in gold, silver, and platinum when you are really just investing in some random company. Look at the huge discrepancies between the commodity and the companies that handle it. Let's get back to our nice view of gold, silver, and platinum, moving up and down 10%, showing you exactly what metals prices reflect. The small precious metals futures track this basket of commodities as well as any product could. No more random moves in your portfolio not reflecting the market you came to trade. But here's where futures usually lose out. No one wants to read another table of contract specifications that tell you all the things about a market that won't help you make money. It's crazy that you need to study new specs every time you look to enter a new asset class. And sometimes you have to do so within the same asset class. If I'm trading traditional futures in metals, I have to multiply my gains or losses by $100. In equities, my fluctuations are priced in values multiplied by $50. And when I jump over to foreign exchange, my P&L is at the disposal of a $125,000 multiplier. The calculations required to trade across asset classes are time-consuming and antiquated. Now the retail trader is no longer held hostage by the large institution with its specific multipliers. One tick increment, one multiplier, all smalls products. You used to look for trades in gold only to find that you have to think in dimes that amount to $10, and then move on to stock markets that move in quarters that equal $12.50, before concluding at a forex market that fluctuates by half 10,000ths of a penny. One tick increment, a penny, one value, $1, all smalls. Finally, pure exposure has long come at the expense of flooding your calendar. Every asset class with its own expiration day that you are at the mercy of for simply wanting access to more than stocks. All smalls products will expire on the same day of the month, the third Friday, and each market will have an expiration every month so you can forget about which month codes are attributable to which markets. The smalls want you spending time trading them, not studying their specifications. When it comes to the amount of context that a product lends to a market, the battle between futures and stocks is one of too much and not enough. But neither offer clear context that gets you from idea to execution quickly. Futures can give you access to a wide world of financial instruments and commodities, ranging from a small nation's currency to broad oil indexes, whereas stocks can show you a world of, well, stocks. But how much is too much? When throwing the magnifying glass on the asset class of foreign exchange, you are given several ways to trade the US dollar, all at the expense of another region with its own politics. It's nice to have access to Forex, but having to learn everything about relative exchange rates just to trade dollars is too much. You came here for a simple trade based on your research. The small exchange offers simple takes on all the major asset classes, allowing you to trade your ideas without having to obscure them with confusing products meant for someone else. Let's take a look at what you'd be trading at the small exchange. Small dollar connects you directly to USD while diversifying against the world's 7 largest economies, so you no longer need conversions when trading foreign exchange. Small Stock 75 finds the most dynamic stocks from the 5 major sectors and adjusts with shifts in the equity environment, so you stay trading an active stock market. Small Precious Metals combines gold, silver, and platinum relative to their consumption, production, and volume, so you trade the developments that matter most in a changing metals market. Small Global Oil blends major crude oil benchmarks from the US and abroad to reduce geographic bias, so you can simply trade oil. Small 10-year US Treasury yield cuts out the complexities of bond pricing and takes you straight to the yield you know, so you can skip the calculations and just trade interest rates. The days of making 3 left turns to arrive at your trade destination are long gone. Now you can make 1 right turn with the smalls. In summary, the small exchange is bringing you efficient capital that can be tailored to any account size, universal construction that tracks directly, and clear context that accelerates ideas to execution. These are products made for everyone. We put all of our effort into creating futures that are built for new traders looking to try affordable products, existing traders looking to scale trade ideas, and everyone in between. And finally, the smalls are used to speculate on short-term action, invest in long-term direction, and hedge portfolios of any size or asset. When you speculate on the smalls, you are getting true bang for your buck. In this example, a $400 profit in SFX would yield you around a 100% return on capital. The ETF version of this product would, at best, earn you a 5% return relative to capital requirements. The smalls also lend to larger potential returns when investing. Instead of having to lock up thousands of dollars for relatively small returns on investment, Our products add efficiency to long-term investments in any asset class. Finally, hedging with the smalls is easy. Say you want to hedge the gold, silver, or platinum that's sitting in your portfolio. The smalls make it cost-effective and flexible when reducing exposure by selling the small precious metals when you want the hedge, and then buying it back when you'd like to return to full exposure. Lastly, the small exchange subscription gives you a lifetime of reduced exchange fees when you're speculating, investing, and managing risk with the smalls. And it keeps market data fees low past the first year of $0 market data fees. Visit subscribers.thesmallexchange.com for more information on buying one of our subscriptions. Ready to trade the smalls with a leader in futures trading since 1988? Go to canontrading.com/communities/small-exchange. You can open an account and get more information on trading the smalls. Also, go to smallexchange.com for more information on our products and our exclusive subscription offer that lets you save every time you trade the smalls. Thanks for tuning in. Have a great day.